In early 2019, WeWork, a company selling office space, was valued by investors at a staggering $47 billion. Its charismatic co-founder, Adam Neumann, envisioned a global community, not just a workspace provider. Yet, within months, this valuation would plummet, the highly anticipated IPO would be pulled, and the company would teeter on the brink of collapse. This episode delves into how a startup promising to elevate the world's consciousness spiraled into one of the most significant corporate governance failures and investment disasters of recent memory. We examine the claims, the evidence, and the monumental losses. Founded in 2010 by Adam Neumann and Miguel McKelvey, WeWork presented itself as more than just a landlord. Neumann asserted, "We are a technology company, aiming to disrupt the traditional commercial real estate market by fostering a sense of community and flexibility." The company's S-1 filing, however, clarified its core business, leasing properties long-term and subleasing them short-term to individuals and companies. This fundamental model was a key point of contention for analysts questioning the tech valuation applied to a real estate operation, despite WeWork's extensive use of data and design. WeWork's growth was aggressive, fueled by substantial investment capital, primarily from SoftBank. By early 2019, the company operated in 111 cities across 29 countries. Public records, including its initial S-1 prospectus, indicated WeWork had leases for over 600 locations, totaling nearly 60 million square feet of office space. This rapid expansion, while impressive in scale, came at a significant cost. Analysts like those at Bernstein Research noted that the speed outpaced profitability, leading to mounting operational losses, a factor that would later heavily weigh on its public offering prospects. SoftBank, under CEO Masayoshi Son, became WeWork's most significant backer, pouring billions into the company through its Vision Fund. By January 2019, SoftBank had invested over $10 billion, culminating in the $47 billion valuation. Son's investment thesis often centered on backing visionary founders and disruptive technologies, and he reportedly saw Neumann as such. This capital allowed WeWork to continue its hypergrowth strategy, but it also inflated expectations and masked underlying issues, as noted by financial journalists covering SoftBank's investment philosophy, creating an environment where traditional metrics were seemingly overlooked. The fundamental debate around WeWork centered on its identity: a tech company or a real estate company? According to its S-1 filing, WeWork recognized nearly all its revenue from membership and service fees. Its primary cost was rent. Critics, including many institutional investors during pre-IPO roadshows, argued that this was a thinly veiled real estate play with a substantial tech veneer. This distinction was critical for valuation. Real estate companies typically trade at lower multiples of revenue or EBITDA compared to high-growth tech firms, which often command sky-high valuations based on future potential and scalability. The disparity between perception and reality became increasingly stark. When WeWork filed its S-1 prospectus in August 2019, it exposed a range of alarming details. The document revealed massive losses, reporting $1.9 billion lost on $1.8 billion in revenue in 2018. Furthermore, it highlighted serious corporate governance concerns, including Neumann's control via supervoting shares, significant related party transactions, and the company paying Neumann $5.9 million for the We trademark, which he then returned. Journalists at The Wall Street Journal and Bloomberg extensively covered these revelations, noting the stark contrast between the company's public image and its internal financial realities, leading to immediate investor apprehension. Beyond financial disclosures, reports surfaced detailing Adam Neumann's eccentric and often self-serving behavior. Sources close to the company, quoted by Vanity Fair and other publications, described his lavish lifestyle, including private jet usage and parties, alongside allegations of excessive alcohol consumption and a chaotic management style. Critically, the S-1 filing showed Neumann owned stakes in properties leased to WeWork and secured a personal line of credit using company stock. These revelations, coupled with the $5.9 million trademark sale, painted a picture of a founder leveraging his position for personal gain, deeply unsettling potential investors and raising ethical questions. Following the S-1 filing and subsequent investor pushback, WeWork's once lofty $47 billion valuation began to unravel with alarming speed. Investment bankers, initially targeting an IPO valuation of around $20 to $30 billion, quickly revised their estimates downwards to as low as $10 billion. The public market simply refused to accept the private market's valuation multiples for a company with such high losses and governance issues. By September 2019, facing overwhelming skepticism and a complete lack of appetite from public investors, WeWork officially withdrew its IPO prospectus, marking a humiliating retreat from its public market ambitions. With the IPO dead, WeWork faced a liquidity crisis. SoftBank, already heavily invested, stepped in with a new bailout package valued at over $9.5 billion in October 2019. This deal gave SoftBank an approximate 80% stake in WeWork and, critically, ousted Adam Neumann as CEO, albeit with a reported exit package worth hundreds of millions. However, SoftBank's involvement came at a tremendous cost. Its Vision Fund reported a staggering $18.5 billion operating loss in May 2020, primarily due to its WeWork investment write-downs. This demonstrated the immense financial impact of backing a company that failed to meet public market scrutiny. After Neumann's departure, WeWork embarked on a painful restructuring under new leadership, aiming to cut costs, sell non-core assets, and regain investor trust. They eventually went public via a SPAC merger in October 2021, but at a vastly reduced valuation compared to its pre-IPO peak. Despite efforts to stabilize, the company continued to struggle with high lease liabilities and adapting to post-pandemic shifts in office work. Ultimately, in November 2023, WeWork filed for Chapter 11 bankruptcy protection in the US and Canada, citing unsustainable long-term leases, a culmination of its decade-long journey from an innovative disruptor to a financial cautionary tale. WeWork's dramatic trajectory offers several critical lessons for investors and entrepreneurs. Firstly, the distinction between private market valuations, often driven by venture capital's optimism, and public market realities, governed by stricter financial metrics, can be immense. Secondly, effective corporate governance and checks on founder control are paramount. Adam Neumann's extensive powers and self-dealing were major red flags. Lastly, the tech company label cannot indefinitely obscure a fundamentally different business model. As analysts from institutions like J.P. Morgan noted, the core business must eventually justify the valuation, irrespective of the narrative. The story of WeWork is a complex narrative of ambition, innovation, and ultimately, a spectacular fall from grace. Its $47 billion valuation disaster highlights the perils of unchecked growth, a flawed business model masquerading as tech, and a governance structure that prioritized founder control over investor protection. While WeWork may continue in a diminished capacity post-bankruptcy, its journey serves as a powerful cautionary tale, echoing across the startup ecosystem. It underscores the critical need for financial discipline, transparency, and a grounded understanding of value, proving that even the most compelling vision cannot escape economic realities indefinitely.